actually very excited as we look forward for the next decade. There is no shortage of uncertainty out there. You have a war in Ukraine, you have tensions between the US and China, we're going through economic policy normalization. There's a lot of reasons to believe that the fundamentals of the business are what are going to be rewarded moving forward. Finding companies that can generate sustainable free cash flow and consistently return the cash to shareholders in the form of dividends, share buybacks, and debt reduction will be rewarded. In the face of uncertainty, people like the fact that companies that pay dividends are cash flow positive today. You have a reaffirmation that they have the cash flows when they're consistently returning the cash to shareholders in the form of dividends. So we're quite excited about the opportunity set as we move forward and move towards a market trading more on fundamentals and less about central bank policy moves.
A stock that I would point to that is a good example of what we're looking for is Novartis. Novartis is a Swiss pharmaceutical company. It's a large company, has a market capitalization of about $200 billion, generated about $50 billion in revenues last year. The company pays an attractive dividend. The dividend is a little over 4% today. The dividend's been growing consistently and reliably year after year for more than 20 years. The company also regularly repurchases stock. So good capital allocation practices. One of the things that we like about the company is the way the management team in recent years has been narrowing the focus of the business. They've divested businesses that are unrelated to their core interest, which is innovative medicines. And with this more narrow focus, we see a much more dependable driver of growth and growth in cash flow. In 2022, the company generated about $13 billion in free cash flow. So this means cash flow generated after paying all their expenses, after paying taxes, indeed after about $9 billion in R&D expense in 2022 and a little over $1 billion in capital expenditures. So with that free cash flow, they pay an attractive dividend. The dividend grows over time. They buy back stock and they invest to grow the business as well through business development opportunities. So good capital allocation practices. One of the other things that I'd mention about this company that we like, because it's a large business, a large pharmaceutical business, it has exposure to a number of therapeutic areas across a number of geographies, and this lends to more stability for the business. So they have blockbuster drugs in oncology, in immunology, in cardiology, in neuroscience. So they've got very clearly defined therapeutic areas that they're targeting. They've got big drugs that are generating billions of dollars in revenues and growing in those therapeutic areas. And it really is a company that in many ways ticks all the boxes for us of what we're looking for the shareholder yield strategy.
Coca-Cola Euro-Pacific Partners is a great example of a shareholder yield holding. It is the largest independent bottler for the Coke franchise with operations in Europe, Asia, and Australia. The company benefits from product innovation and marketplace execution. They have an opportunity to reinvigorate their growth and cash flow right now because they're working through the acquisition that they recently did in Coca-Cola Amatil, and they can restructure the product lineup and the costs of the business. They consistently return cash to shareholders through an attractive dividend, which is also supplemented by share buybacks and debt reduction over time. Coca-Cola Euro-Pacific Partners is a great example of a company that generates strong free cash flow and consistently allocates capital back to shareholders in the form of dividends, share buybacks, and debt reduction.